Welcome back to the Financial Shepherd podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back in home studios today after some blowout earnings that we're going to get to from CrowdStrike and NVIDIA, the reaction after their earnings announcements, our thoughts, of course, a whole bunch of other information to share with the audience as well. So, welcome back for those that are recurring viewers of the Shepherd Wealth Management podcast. Please like, share, and subscribe Shepherd Wealth Management to your friends, family members, and coworkers because we've got a lot of great feedback in doing this show over the last 4.5 years. And the main reason for that, of course, there's been a lot of news headlines over the last 4.5 years that have helped investors from a emotional standpoint, driving up fear and certainly placating to some investors' greed, which we'll talk about in today's program as well. But the main reason why we've gotten such great feedback from this show is, regardless of all those news headlines, the market has been made up of a bunch of human beings that allow the market to move up, down, and sideways. And unfortunately, humans are hardwired with these emotions called fear and greed. Thanks to studies like behavioral finance, we've learned that humans feel losses twice as much emotionally as they feel good about making gains. So we are risk averse by nature, and the news plays into that. So they can drive viewerships, which is generally the reason why news headlines are negative. We're not saying that that's a bad thing because they should bring things to your attention, whether it's scary or not. But what we are simply here to point out is one, that is a fact that the news is generally going to placate to the fearful side of your emotions because you're twice as engaged as you would be if it was positive news. Again, going back to the risk averseness of human beings. But what we're here to do is say, yes, this is what's going on. This is why it's important, why this is being brought to your attention. However, it's usually not the first time we've been through whatever it is that the news is talking about. And there's generally a precedent for that. And that's what this show is all about, is to help put the proper risk and reward of investing decisions in its proper context so you can make consistently good decisions with your own portfolio. And that's worked out really well here for our customers at Shepherd Wealth Management. And by the way, that's a very uh, good way, in our view, to generate value for yourself, your family, or in our case, for our customers. Because most professionals in this business that we're in here, they do things pretty much the same way across every institution, whether you're talking about very big companies like the Fidelities of the world that I used to work at, large banks, and others. They generally do all this stuff very, very similarly or almost the exact same way. So they're competing on their price point, whereas we're competing on value. And the way that we're driving value for our customers is twofold. One, we're helping them get control over their emotions by understanding the history of the market. In other words, how have other human beings behaved in very similar circumstances. And what that does is two powerful things. One is it actually does what Warren Buffett says is the number one reason investors do not achieve the results they're looking for consistently over time is that they have no control over their emotions when they see these headline news that relates to their money. And because it's the number one thing that investors struggle with that prevents them from achieving those results consistently over time, well, that's why we want to bring this historical data to the audience here. And if this is your first time watching the program, welcome. We love having you. Please, again, like, share, and subscribe to Shepherd Wealth Management Podcast. But once you have full control over those emotions, the second important thing that it does is it puts risk and reward or whatever decision making process you're about to implement, makes it very clear of what the risk and reward is. Now, of course, there's no guarantees with investing, and past performance is not a guarantee of future results. Investing does involve risk, including risk of loss. And any of the companies that we talk about here today or in the future on this particular program, we don't get any kickbacks from these companies in any way, shape, or form. And I don't have any recommendations for the audience of this particular show because I only make recommendations to my individual clients that I understand their situation and risk tolerance very, very well. So, with all that out of the way here, Ez, very excited to be back again in home studios here with this Thursday. A lot to get to. And the really cool part is we got Labor Day weekend coming up. Lots of fun activities planned. I'm sure there's some stuff going down in Nashville too. And on top of all that, we got high school football, college football coming this week, pro football coming next week. Anything that is a particular interest for you right now as we're wrapping up summer?
Yes, it is not sports related. However, the weekend after Labor Day, Saturday, September 6th, I am going to see my favorite band, Nine Inch Nails, play at Bridgestone Arena here in Nashville. So I'm excited.
Very, very cool. I guess you cannot wear white after Labor Day, so there's something to be said about that. But that's not what this show's all about.
No, and that won't
Um,
impede on my wardrobe at all. Anyone who watches this show can
no
tell.
doubt.
Big fan of black.
That's what I was going with. But cool, very, very exciting. That's awesome. Concerts are definitely rolling around now. Hopefully, I'll get a chance to catch one. It's going to be difficult though with all these kids running around and back to school and cheerleading and football and everything else. So it's an exciting time of the year. And I know that we were chatting about it before the program, but the Reds got swept for the first time in 2025. They're the last team in professional baseball to get swept this late in the year. But unfortunately, got swept by the Los Angeles Dodgers, the world famous LA Dodgers with a massive payroll. And they're clearly a better team. It was very, very difficult to watch them get destroyed pretty much for three straight games. But they're about three and a half games out of the wild card here in Cincinnati. So we'll see what happens with it's called really just a month left of baseball.
Yeah, I mean, maybe what, 40 games at the most. That's probably rounding up at the.
Yeah,
I mean, yeah. So
we'll see. We shall see. But yeah, we got a lot to get to today, and unfortunately, I don't think we'll have a lot of time to talk about the Cracker Barrel logo. Uh, although, although I am happy to see that they're sticking with the old logo and the nostalgia. I mean, I guess since we brought it up, the one thing I'll say about that, I'm not a big Cracker Barrel guy. I really am not. I like the little store. I think it's like stepping back in time. I think that's the best thing that Cracker Barrel, in my opinion, my little humble opinion, has it going for them. They've created a niche for themselves. What other store, whether it's a restaurant or retail store, where you feel like you're taking a step back across decades in time when you walk in there? They've created an environment, a niche, and that's the reason why I think that there's the backlash that there is. And that's just my little 2 cents about this fascinating story that's being covered by the news on their logo. So, for all the marketing majors out there, you have a career ahead of you. You just have obviously have to make good decisions based on what your customers are looking for as opposed to what you think might be cool.
Yeah, I
But,
mean, like you said, they definitely have a gimmick. Like, I feel like Cracker Barrel's slogan, for me anyway, should be like, "When there's not Waffle House." Like, that's what they should call themselves, right? Because like, that's the only time I step into Cracker Barrel's when there's not a Waffle House around. I'm on some kinda road trip. And, you have
yeah,
that entry store and all the rock candy, all the stuff from basically, like, the Great Depression is in there. That's like you said, they wanna sell that 1920s and previous vibe, so
I think it's super cool.
I mean, yeah, if that's what you're looking for, it is cool, and,
What's a niche?
obviously, it resonates with a lot of people, and I think that
Yeah,
regardless of who you are, even if you never set foot in a Cracker Barrel, you probably think about road trips when you see one, right? Because
yeah,
Cracker Barrels aren't usually, like, in the middle of downtown Nashville, they're off on the interstate somewhere.
that's right.
Again, I none of it bothered me, but I'm not a Cracker Barrel, frequent card holder, like, I don't have, like, a Kroger Plus Cracker Barrel card.
Me neither.
So, hey, yeah, I mean, they're reverting it, so I guess there was a significant backlash for them to do that, and I
Big
have
time.
yeah.
Yeah, I mean, it was bad, real bad. I don't know if the CEO is gonna make it past this one or not, but, this will definitely be a case study for marketing majors, no question about that. So,
Yeah, I mean, it's bizarre. It didn't change the food or my perception of it, but again, I'm
no.
not a patron of Cracker Barrel, so I don't know what that was.
Well, yeah, that's the thing though. This is my thing from a business perspective is they can't compete with eggs and toast and bacon. They can't.
No.
However, they can create an environment that provides you this feeling of, oh, I'm taking this step back in time. And you just can't get that anywhere. It's not that is the value that they're selling more than anything else. And I'm happy to see that they got the message from their audience. That's probably the main takeaway there is the customer, the paying customer, has the final say. And That's who you might want to pay the most attention to. And it seems like they got that message very loud and clear, which wouldn't have happened had it not been for social media, to be honest with you. And so I guess you could say social media does have some positive roles to play here.
Yeah, it kind of, I mean, the whole thing reminded me of some of the various attempted Coke rebrands from the 90s and early 2000s. Remember that? They tried their best
You
to get
Coke?
away from that cursive
Yeah.
Coca-Cola thing. And finally they were just like, F it. Everybody for some reason needs to have this written on their can.
Yep.
So
Yep. Listen to your customer for
yeah.
sure. And yeah, I got a couple things that I wanted to kick off today's show with now that we've got the Cracker Barrel story out of the way. By the way, it just happened to pop up here. The stock on my TV, Cracker Barrel, unfortunately, is down almost 4% here today.
Buy the dip.
Um, that's not, not a recommendation,
Get the
not a
dip.
holding.
They're reverting their branding.
Although I would say it was a nice buying opportunity for those that did have the intestinal fortitude to do that during all of that sell off because it did have a nice pop and it did reach an all time high, even higher than where it was before all this stuff happened once they decided to go back to the old brand. So I guess that's where we'll leave the Crackle Barrel story for today. If you have some comments about it, maybe you've studied their stock better than we have. It's not something that we're into right now, but it is making news. So we thought we'd start the show this way. And I love your feedback on Crackle Barrel, their stock, the company, or your own personal experience there. You can leave that in the comments section below here on YouTube. But without further ado, let's jump into some very important earnings. These are current holdings for our customers, and I definitely want to talk about them because this show is for our customers. Of course, we love when new people that aren't customers are enjoying this show. So again, please like, share, and subscribe to Shepherd Wealth Management Podcast. We love your questions and feedback. But yeah, these are two big ones here. CrowdStrike, essentially the nation's largest cybersecurity company, reported earnings yesterday after the market closed, and the total revenue was 1.17 billion for the quarter. This is up 21% year over year, beating analyst estimates of 1.15 billion. Subscription revenue contributed 1.1 billion. This is also up 20%. The net new annual recurring revenue, or ARR, hit a record of 221 million for the quarter, boosting the total ARR to 4.66 billion, an increase of over 20% from last year. In addition to that, their Falcon product, over 1,000 Falcon Flex customers were reached, which was a record. And in addition to that, their profitability and cash flow, non-GAAP operating income climbed to a record of 255 million, representing 22% of revenue. Non-GAAP net income rose to 237.4 million, or 93 cents per share, beating analyst expectations of 83 cents per share. So across all metrics, including their guidance, was phenomenal. I mean, they could not have done a better quarter than that. I think that's exactly what everyone that's in this stock is looking for. This AI story is nowhere close to being done. And we're going to, make that very clear here when we get to NVIDIA's earnings here in just a second. But the AI story is not going anywhere. It's still very much in the early innings. In addition to that, if you're going to have artificial intelligence, crypto banking, which we've talked about in prior podcasts and we'll continue to talk about as those regulations go through Senate, Congress, and ultimately into the White House's hands. If you're going to do all this stuff, this new industrialization using technology here in the United States and around the world, you're going to have cybersecurity. In my own business, this registered investment advisory world that we operate in, this is one of the very most important things that they're requiring of companies like myself is how are you protecting client data? How are you protecting the security of information, their accounts, et cetera, et cetera? None of that's going anywhere. These are themes that are going to be playing for quite a while. Um, and their earnings results are reflective of that. This is by far the best performing, or by far the most dominant cybersecurity company uh, in the world, and it's not slowing down at all. So Q3, just to hit on that before we get to Nvidia. So their forward guidance, CrowdStrike guided revenue between 1.21 billion and 1.22 billion, implying a 20 to 21% growth again. And full year fiscal 2026 revenue is projected at 4.75 billion to 4.81 billion, maintaining growth between 20 and 22%. This is despite an 18% decline in shares this quarter. CrowdStrike remains up 22% year to date and 56% over the past year, significantly outperforming the S&P 500. So the question would always become, hey, is this company expensive? The answer is relative to what? Relative to Procter and Gamble? Yeah. Relative to Pepsi and Coke? For sure. But relative to other AI companies, relative to other cybersecurity companies, absolutely not. And with this type of earnings growth and the fact that we're in such early innings of this industrial AI revolution, I'm pretty excited to be a shareholder of this. Now, unfortunately, this is the weird part to me. This is what we're going to spend a second on here, Ez. When they dropped this earnings announcement after the market closed, so after 4 p.m. Eastern Standard Time yesterday, markets closed, you got after hours activity, and CrowdStrike drops all this awesome earnings news on everyone. The stock was down over 7% in minutes after they dropped this information. So, what does that tell you? It tells you a couple of things. The humans are very, very nervous investors. That has never changed and won't. Like I said, humans are hardwired with these emotions called fear and greed. And if somebody can convince me that humans have changed all that much over the past couple thousand years, I'm all ears. Okay. If you were going to sell the stock because you were nervous about earnings or whatever, get their forward guidance, obviously selling before their earnings announcements would have made sense. You wouldn't have had a lot of arguments for me. I would have argued against doing that for several different reasons that I've touched on here. And there's a whole lot of other reasons I would not have done that. But let's just say you emotionally couldn't handle it, very, very unafraid or very afraid of the potential earnings news or the reaction to the earnings news. I could understand that. That would make some sense to me, right? However, after they dropped this earnings information, investors wanting to sell it to the tune of 7% down. Now, obviously, the stock has recovered here today as I'm delivering this podcast, up about 3% here as we're talking here today on August the 28th of 2025, right about in the middle of the day here, noon Eastern Standard Time. So the stock has recovered all those losses and then some. Um, it's just a very emotional response, right? And you can't say people were taking profits either, especially in an after hours trading session where volumes are extremely thin. So it's just a knee jerk reaction, and people are looking for a reason to sell these big tech names, and they're not finding much of a reason to do so. So this is interesting to me to watch these after hours earnings reactions, but I mean, again, there was zero reason after they delivered this earnings and guidance from CrowdStrike that there was a need to sell anything. So I don't know if it was algos kicking in for some unrational reason. They were looking for a word or phrase or two that didn't actually come up. But as of right now, human beings stepping into their laptops or Bloomberg terminals are certainly buying CrowdStrike shares here today. So that was the first earnings news yesterday. And again, very excited for CrowdStrike's prospects of future growth and very happy to be a shareholder. And if it would have opened up that much down and stayed down here this morning, we would have been glad to buy all the shares that we could from those that for some reason got shook out of just an awesome earnings announcements from CrowdStrike yesterday. Obviously, as the big elephant in the room yesterday after the market closed from an earnings standpoint was Nvidia, the $1 trillion chip maker. The coolest CEO probably right now, Jensen Huang, with his very, very fashionable black leather jacket I don't even know if this guy takes it off anymore. Like every interview he ever does, he's definitely rocking a blacked out Fonzie-esque leather jacket, which I respect. I
Oh, me
respect that
too.
one.
I mean, you know me, the leather jacket, to me, it's a faux leather jacket, the one I have, but it's in the heavy rotation in my wardrobe. I wouldn't be surprised if CEO Wong's was actually some kind of high tech, like second skin that he can just grow whatever he wants. You know, he's got like that kind of weird billionaire CEO technology where it's like the Venom costume. You know,
Yeah.
he's just like, I got to stunt on everybody right now, and it just turns into that.
I mean, I wouldn't put anything past this guy. This is one of the better CEOs and salesmen. I think he understands that about himself, which I
For
think that
sure.
that's another podcast in and of itself. I could really deliver, I think, some strong content for those that are looking at trying to be an entrepreneur, like to study other entrepreneurs and those sorts of topics. But maybe we'll save that because we just got too much to get through here today with data, and then of course Fed meetings coming up and so on and so forth. But Nvidia stock is already up 35% year to date, almost tripling in 2024. Earnings per share came in at $1.05 adjusted. That beat estimates of $1.01. Revenue came in 46.74 billion. Analysts were looking for 46.06 billion. Nvidia said it expects revenue this quarter, Q3, to be 54 billion plus or minus 2%. And the number does not assume any zero H20 chips to China, which is obviously headline news. This year, as this administration did not want any chips, even the lower or less powerful chips, to be sold to China. However, it seems as though that it's possible that Nvidia will be allowed to sell some of these less powerful chips to China, which is not reflected at all in the guidance that they provided. And this is the reason why the stock, in my view, is down, let's call it 2%, down as much as 3% earlier today and after hours. And if this persists as we get into the latter afternoon trading hours of today, it's certainly a stock that I'm looking to add to the holdings that we already hold for our customers because they absolutely crushed every metric. And if you're going to sell the stock based on that, I mean, that's the only reason that you can make a case to sell Nvidia stock, in my view, based on the earnings announcements that were released yesterday after the market closed. If they're giving you guidance that's better than analyst expectations and does not include roughly $6 to $8 billion worth of chip sales that they could sell to a country like China in one quarter, I don't know why the hell anybody would want to sell the shares. It makes zero sense to me. They're crushing their earnings estimates, revenue, top line and bottom line. Pretty much every sector of their business outperformed. One minor miss in the data center. I mean, very, very minor miss. So if you want to hold that over their head, I guess you could. But again, the numbers that we have here from this quarter and the guidance that they're providing is zero chip sales to China. Okay. If they can sell any, obviously they're going to destroy whatever earnings expectations that analysts want to slap on Nvidia as we get through the rest of Q3 as the month of September arrives here very quickly. So again, people are selling shares in a very minor miss on one part of their business, which would have outperformed had they been allowed to sell chips to China in this Q2 earnings announcement. And their guidance is much better than what analysts had presented for Q3, the quarter that we're in right now, which wraps up at the end of September, which is right around the corner. If they can sell any chips at all to China, they're going to blow it out of the water. And they already are blowing it out of the water without those sales. Overall, company revenue for NVIDIA rose 56% in the quarter from 30.04 billion a year ago, NVIDIA said, and now they're over 50 billion. Year-over-year revenue has now exceeded 50% for 9 straight quarters, dating back to mid-2023 when generative AI boom started. So it's been a while, and this AI story has done nothing but accelerate. NVIDIA said, again, there's no sales to the Chinese companies for their H20 chips, but net income did increase 59% to 26.42 billion. and that came up from 16.6 billion a year ago. So this company is absolutely, I mean, firing on all cylinders is the wrong word. Their only problem is they cannot make the product fast enough. And in addition to that, they keep rolling out new products to continue the growth story. Part of that is certainly the gaming division. And as I know that you're a big fan of the gaming division here for Nvidia and other companies, but gaming division reported 4.3 billion in sales. This is up 49% from a year prior.
Love it.
Um, the company's robotics division remains a very small part of Nvidia's business with 586 million in sales during the quarter. This represents 69% growth. And they're doing 60 billion in share repurchases. And last but not least, their margins. Nvidia's margins are expected to be about 73% based on the guidance that they've provided here. So, I mean, you cannot convince me based on this information. Not this. I mean, again, here's the actual number regarding their gross margins. 73.5% reported their gross margins. So, and all the other major tech companies, the Microsofts, the Alphabets, Amazons of the world, they're not slowing down their spending. We just got through their earnings information several weeks ago, and all of them said the capex spend for AI, artificial intelligence, is still there. It's not going anywhere. So again, this placates right into CrowdStrike, cybersecurity company. If you're going to do this industrial AI revolution boom, that is the expectation, and NVIDIA is right in the center of it. I don't know how you could possibly logically sell your shares based on this information on NVIDIA. But hey, I'm happy to take your shares if given the opportunity here later today, this afternoon, with the stock being down about 2% as I'm delivering this information. But none of those big hyperscalers I just described, the Apples, the Amazons, the Alphabets of the world, they're just not slowing down the spending at all. Matter of fact, according to Jensen Huang, in the earnings call, he expects these hyperscalers to spend $4 to $5 trillion on AI investments over the next 5 years. And again, NVIDIA is going to be right in the center of all of that. Now, they're going to have competition at some point in time. I don't know where it's going to come from, but right now, um, they got the best product on the block. And it happens to be a very, very highly important um, segment of the global economy, but certainly here for the United States economy. It's awesome to have these American companies, dominate globally. It certainly is really awesome to see, and I'm very excited to be a NVIDIA shareholder, and looking forward to the opportunity to acquire additional shares if given the opportunity later here today. Now, on top of all that, wonderful earnings news that we got yesterday after the market closed. This morning at 8:30 in the morning, we got some additional macroeconomic data. And the initial jobless claims, we'll start with that. So the initial jobless claims, economists were expecting 230,000 initial jobless claims. It came in a tick lower than that, 229,000 initial jobless claims. And last month, it was 234,000. So that's certainly trending in the right direction. GDP, gross domestic production, this is a revision from Q2. The original number was 3%, which is awesome. GDP growth, 3% is awesome. However, economists were expecting 3.1% for the reading today. It came in at 3.3%, also moving in the right direction. And by the way, earlier this year, the CBO scored the big, beautiful bill that was passed by Senate, Congress, and ultimately signed by the White House. They were only accounting for about 1.8% long-term GDP growth. So if numbers come in like this, month after month, quarter after quarter, it's a very low estimate that the CBO had scoring that bill, which is falling right in line with their history of underappreciating the potential growth aspect of the U.S. economy. So I'm very excited for the prospects of not just the companies that delivered earnings, or the earnings in general for Q2 were just stellar, and none of the earnings expectations are coming down. So let's add all this up here real quick before we get to my next topic, which is the Fed's meeting coming up in September. You have back-to-back quarters, Q1, Q2, awesome earnings from corporate America. By the way, they had about a 7 week sell off right in the middle of Q1 leading into Q2. That was the fifth fastest drop in S&P 500 history, driven by not data, but driven by emotions, thanks to the media. We covered all of that. So you can check out prior Shepherd Wealth Management podcast around middle of February through April. And we were right there in the center of it, covering all of that. On top of that, you've had all kinds of changes from the administration from a policy perspective. That's caught a lot of headline news. It's driven investors' emotions one way or another, depending on your perspective. And here we are with all time highs or near all time highs across the major averages. Corporate earnings, the CEOs and CFOs had every reason in the world to pull their guidance for pretty much the rest of the year. They haven't. And those that did, they reiterated their guidance after Q1. You have a Fed, which we're going to talk about here in a minute, that's likely going to be cutting rates here in September. And what does the stock market understand about Fed rate cutting cycles? Well, when you start a rate cut cycle, more rate cuts are coming. So that's certainly a good thing, a bullish thing to keep this bull market going. Earnings, probably one of the most important things, not slowing down, accelerating. What's equally important to earnings is jobs data. Just covered that. We get one more jobs data print before the next Fed meeting, so that'll be very important, along with one more inflation look before the Fed's meeting, also very important. But jobs are fully employed, 4.2% unemployment rate, initial jobless claims in check. That's maximum employment to me. Those are good things. Fed rate cuts are certainly a good thing. On top of all of that, you have less taxes are going to be paid by companies and individual households on average. But more importantly, that's not really discussed much at all in the media at all, is the deregulation aspect of the bill that was passed that really won't take hold into the US economy until late Q4, but certainly by the beginning of next year, given the lag effect that will have on the US economy in a good way that should deliver growth. But on top of that, historically, and we'll have a lot more to say about this as we get to the Q4 part of the year here. Historically, the second year of a presidential cycle, which will be next year, is typically one of the best performing years for stocks during a presidential cycle. So you got a lot of historical reasons to be excited. You got a lot of fundamental and macroeconomic data reasons to get excited. But more importantly, as we come into the month of September, well, what are the probabilities given all this news, earnings, uh, macro data, GDP? We also have jobs data. What is the rate cut expectations for the Fed's meeting in September, September 17th to be exact? Well, there's an 87.2% chance that the Fed cuts rates by 25 basis points. So, what can make that change? Well, as I mentioned, as we get between now and the middle of September, we're going to be getting some additional jobs data, and we're also going to get some additional inflation data. So, let's play devil's advocate here for a second. If the jobs data comes in roughly around what it has here over the last several prints, you still have maximum employment. And if jobs data comes in weaker, well, obviously the Fed's already said, based on their Jackson Hole comments, that they're more focused on the labor side of their mandate than they are on the price stability or the inflation side of their mandate. But if inflation happens to come in soft or in line with expectations and jobs data comes in soft or in line with expectations, well, you still achieved your dual mandate of maximum employment. That box has been checked for quite a while, and price stability. You're not seeing runaway inflation that the Fed chairman said would happen earlier in this year based on policies that were promised from this new administration. So when you have both sides of your mandate met, it's time to cut rates. If jobs data is soft, it's sure as hell time to cut rates. So the only way that the Fed would have any leg to stand on not cutting rates is if you saw a massive spike in inflation, and that has yet to be found. We'll keep our eyes, obviously, on all of the data as it continues to come in, but that is the reason why the probability of a rate cut expectations from the Fed has not changed. If anything, it's gone higher with more of a likelihood that the Fed will cut rates in their mid-September meeting. And this is all being priced into stocks as we're talking here today. But what's shocking, of all that good information, people are still apprehensive about what may or may not happen in the future. There's still all-time highs of cash sitting on the sideline that's missed out on all of the growth that's happened so far this year, which is why we've repeated this idea that any pullbacks in the stock market is likely going to be very shallow because all of this money that humans are sitting on, they see all the information that I'm talking about, even if they disagree, even if it makes them feel terrible about participating in a market, giving all the uh, news headlines coming out of Washington, uh, also coming out of other parts of the country too, depending on where you live, California, Chicago, and other parts of the world, Florida, Maryland, etc. You might have a completely different political perspective, bias, whatever. You're allowed to have those things. I'm not saying that that is a bad thing, but if you want to have consistent success, when it comes to this thing called investing, then you need a process that removes emotion from your decision making process because you're always going to have news headlines that look fearful. You're always going to have somebody else in a seat of power, whether it's the White House, Senate, Congress, Fed, wherever, your mayor, city council, man or woman. There's going to be somebody in there that's going to do something that you probably disagree with. You're going to have a process if you want to have consistent results. Or so you're going to say that you only want to make money every 2 years when everything lines up perfectly with the Senate, White House, Congress, your mayor, city council people. I mean, come on. You're going to have a process to deal with all these bad headlines. That's why I keep talking about the importance of looking at the market through a lens of history. What that does is it puts risk and reward into its proper context. It removes the here and now news headlines that are driving all the fear. It takes the emotion away from the decision making process and it makes risk reward very clear. Once you understand what the risk and reward is, now you can begin the process of building an asset allocation, a mix of stocks in different sectors or bonds and stocks or whatever it is that fits up your personal risk tolerance and goals for your money. You can define that clearly now and understand exactly the percentage that you want in those various asset classes to get the kind of result that you're looking for consistently over time. And if that's a struggle for you, this is what we're here to do. This is why we wake up every day and do what we do for our customers. I'd love to have the opportunity to sit down with you and help you better understand what we're talking about and how to apply it, what it would actually look like for you specifically. So hit us up, hit me up, 513 630 2664. And as we go into tomorrow, tomorrow is Friday, August 29th, wrapping up the month of August. The Friday before college football kicks off with a massive matchup between the Texas Longhorns visiting my Ohio State Buckeyes in Columbus. I'm very excited about that. I'll have to watch that on the old iPhone, unfortunately, because I will be very excited to be at my middle daughter's first grade cheerleading football game, which is at the exact same time. So for all the dads out there during this particular football season with kids, I'm right there with you. We're gonna get through this and enjoy it all together, and be there for our kids at the same time. But tomorrow, Friday, August 29th, we have a couple pieces of important data. Personal income, that's going to be very important. The spending from Americans, very important data that we'll get at 8:30. On top of that, we get PCE, the Fed's favorite measure of inflation. PCE year over year estimates are for 2.6%. So anything in line or lower, awesome. Fed's favorite measure of inflation is the core PCE index. That's expected at 0.3. That's been the same number all year long. Economists has expected zero point 0.3 pretty much month in and month out for core PCE. I think they're just guessing based on just that information. So again, anything lighter than that is definitely going to be a big win. Um, and on top of that, the year over year core PCE expectation is 2.9%. Last month it was 2.8. So if we can get back to 2.8 or lower, obviously going to be a big tailwind for stocks as well. So there's still some drivers out there that could pull the market one way or another. You're still in a very seasonable weak period of time historically for investors. The month of September is more often than times a negative month to be a shareholder than a positive month. So part of the reason we did a rebalance last Friday for our customers is in preparation of this seasonal weakness. Now, history does not have to repeat itself. There's certainly probabilities that could happen where the month of September is positive, and I could say the same thing for most of October. And most years isn't an awesome month for investors, at least not the first part of October. But the main reason for all of this seasonal weakness is you're going to go through this Fed meeting mid September, and then there's really no data until we get to about the second week of October when earnings season kicks off again. So, this information that we're about to get here tomorrow and about a week before the Fed meeting regarding new jobs and inflation prints, very, very important because that's the only thing that the news is going to have, to talk about. And if there's any opportunity for them to shed a negative light on any of these numbers, they're certainly going to do so. And then the conversation is going to turn into, well, based on this information, what if this were to be something that continues, and how is the Fed going to consider, their dual mandate? That's going to be the topic of conversation pretty much between the Fed meeting all the way until we get to earnings season again. So seasonal weakness, which is why we did a rebalance. We added some extra diversification. We took profits from sectors like tech and consumer discretionary without selling all of those profits, and added some positions in the industrial and small cap sectors. We're still holding on to about half of the cash that we wanted to put to work because we expect some seasonal weakness based on that historical data. And we're very bullish about the back half of this year and going into next year. So we're hopeful to pick up some additional shares of companies and sectors that we really want to participate in and have participated in all year long at potentially lower prices, but we're not expecting major pullbacks from the major averages due to the fact that there's so much cash, nearly $7 trillion is still sitting in money markets that missed out on an S&P 500 that's up 10% year to date. And I think that the fear of missing out for humans is very real, and we'll look to put that money to work at every opportunity that they get. So we're prepared to do the same thing for our customers as well as part of the way that we manage risk for them. We're not trying to time anything. I know for certain that I cannot time the bottom of any of the major averages, or let alone any sector or any individual company within those sectors. But I do know the risk and reward of participating in those sectors, given all the information that we have, not so far this year, but also based on historical data going back decades. And thankfully, what we can say for our customers is, on average, across all client accounts and net of fees, we've outperformed the S&P 500 year to date by about 15%. Some doing much better than that. Again, this being an average. So some not doing as well given their risk tolerance, but very, very proud of the process that we've developed and implemented consistently over all of these major headlines over the last 4.5 years. And as you've been right here with me on all these podcasts, over 1,000 videos up on YouTube, if we were to sit down and talk about any one of those negative news headlines over the last 4.5 years that we've been in business doing this portfolio management and financial planning thing for our customers, any one of those news headlines in a silo all by itself, 40-year high inflation, two wars popping off, major political changes that affect geopolitics and interest rates and everything else. If you were to look at any one of those news headlines, and there's a whole lot more over that
Yeah,
4.5 years.
pandemic,
Oh, God.
pandemic. Yeah, I
Yeah.
mean,
The pandemic. Yeah. I mean, all kinds of stuff, right? Any one of those news headlines in and of itself could have made any one of our customers' performance, or yours, if you're doing this by yourself, it could have made your performance look like the markets or worse, which is where the majority of investors, not just here in America, but around the world, are looking at when they look at their own situation or their own balances over the last 4.5 years, comparing it to the S&P or the NASDAQ, and a massive underperformance that most investors are struggling with. And thankfully, the difference between our result and the markets is what I call value. And it has very little to do with me or my team being the smartest person on Wall Street. And that's a very difficult way to make a living here or differentiate yourself between one company like mine and another, because there's a lot of smart people at all these companies. And you can't get a competitive advantage just by looking at a balance sheet. I mean, there's just nothing to gain from being better at reading a balance sheet or an income statement or cash flows better than the next guy or gal. It's not going to hurt, but that's not the main reason for consistent success. Where success lies is developing, again, a process that can take emotion away from all of your decisions and just look at the risk and reward clearly without all the noise. And then you can start to develop an asset allocation around your own personal goals, timeframes, and risk tolerance that will deliver the types of performance expectations that you're striving for, and that is valuable. That is where we stand out from the competition from a performance perspective. But on top of that, we're going to sit down with you every single quarter here at Shepherd Wealth Management. We're going to go over the results, comparing it to the S&P 500 for the long-term growth investor. If that's you, if that's not you, we'll find a better, more suitable index for you. But that's the bulk of our customers here at Shepherd Wealth Management. And every single quarter, we're going to talk about the performance, why it happened, what the expectation should be for the current quarter, and as well as the rest of the year. And along the way, between each quarterly meeting, you're going to hear from us once a week. We're going to write a short blog describing what happened that week, why it happened, what does history have to say about it, what are we thinking and doing about that, and what your expectations should be as a customer. In addition to that, you're going to get a once a month at the beginning of every month, first week of the month, a newsletter covering more information about the prior month, what happened during the month in totality. Why is that important? What does history have to say? How do we feel about it? And what decisions are we looking at making on behalf of our customers, giving all of this information? What should be your expectation? And on top of that, every 2 weeks, Ezra and I are going to get on YouTube and deliver this particular podcast. And the reason why we do all of this extra work, this is for our customers, by the way. The reason why we're willing to do all of this extra work is twofold. One, your current advisor, Ed Jones, Merrill Lynch, pick one, any of the big names that you and I are familiar with, banks, etc., they're unwilling, whether it's their own bureaucracy or just the simple fact that they're lazy, none of them are going to do any of those service things I've just described. And on top of that, none of those entities are going to customize an asset allocation of individual stocks the way that we would on behalf of our customers, because all of those major outfits are managing a lot of accounts, a lot of dollars. They have a investment committee on every one of those major institutions that you and I know the name of. And the investment committee does not speak to the individual customer. The investment committee makes minor decisions, taking, let's say 1% away from US domestic stocks and putting 1% in international ETFs and stocks. That's their big asset allocation change. And they'll probably do that 1 or 2 times a year just to show some activity across all of the millions of accounts that they're responsible for managing. They do it that way simply due to the fact that they do not want the individual representative, somebody like myself that's working at these institutions, to make those decisions on your behalf all by themselves. They're, in other words, not opening themselves up to a lawsuit by managing things the way that they are. And unfortunately, that does not deliver the types of performance individual investors should be getting from these quote unquote professional managers. And I'll make it very plain and simple as to understand why that is. The greatest investor of all time, Warren Buffett, without question, best investor. He said diversification, two things about it. Diversification, which is what all these other institutions are doing because they don't want to get sued, and they can point to academic information as to why that's a proper way to go about investing at all times. Um, they're not competing on the performance side of their business with other companies. That's why they're competing on price. That's why they're willing to drop price and drop price and drop price. That's the only differentiating factor that they provide. They're not going to sit down with you quarterly. They're not going to write a monthly newsletter. They're not going to deliver a biweekly podcast. And they're sure as hell not going to deliver a weekly newsletter letting you know what's going on, why, what does history have to say, and what the actual decision maker, in this case, me and my team, are going to be doing about that. And how are we going to deliver on these expectations? None of them are going to do that. We're willing to do it to differentiate ourselves, but also because this is the exact type of performance and service that I would want if I was going to hire somebody to do all of this stuff for me. And it just happens to stand out in a world where most large companies on their quarterly earnings call, they talk about how important their shareholders are, how important their customers are. They say that to their blue in the face. Um, Is that always true? I would argue no. And the best example of that was what we started the show with, the Cracker Barrel situation. They weren't listening to their customers. They had their own ideas in the silo, and they made decisions that were not actually in the best interest of the business, their shareholders, and ultimately the customers. And they got whacked with backlash because of that, and had to make a lot of changes. So I looked at the situation in this financial services world and said, hey, why can't it be better? Why does it have to be this way? Well, thankfully, I've been blessed with some gifts, and I'm leaning into those as hard as I can for the American investor that's out there struggling with how to handle all of this news that we get on our smartphones every single day and the emotions that that information drives. So that's exactly what we're here. That's why I'm so excited to deliver this every 2 weeks. That's what motivates us to continue to expand upon the product and the service that we provided for our customers. And we're looking to do it for more and more folks across America with some big announcements that we're going to be making here over the coming weeks. So please like, share, subscribe to the Shepherd Wealth Management Podcast. We look forward to doing this again in about 2 weeks. So it'll be post Labor Day into September. And I'm sure we'll have a lot to get to in front of the Fed's meeting. So, with that, I hope you guys have a great rest of your Thursday. Have a great rest of the month of August. Enjoy some football. Hope you guys will be back in a couple weeks. I know we will be. And have a great rest of your day. Take care.